Okay, welcome to Ebury's webinar. Thank you for taking time to join us. We hope to provide here an overview of what is the likely impact of the critical events that are happening this week in the world of markets and currency markets in particular. The Federal Reserve meeting on Wednesday, and then later on the German elections, which are the most uncertain outcome in quite a few years. We will cover these two events while trying to place them in context, in the context of on the macroeconomic and policy context of the world economy. In that context is that we're seeing a fundamental shift away from focusing on COVID and the pandemic, and markets are starting to look past the COVID data and concentrate again in macroeconomic data, particularly inflationary data, and critically central bank meetings and central bank communications, which will remain the key driver for currency markets over the next few months at least. There's a backdrop of unprecedented stimulus, both monetary and fiscal stimulus, as a result of the COVID crisis and the lockdowns that needs to be withdrawn. And the key question is, and what will drive the performance of the different currencies is how fast it is withdrawn in the different currency areas. The point of difficulty for central banks is that inflationary pressures have surprised to the upside. Central banks, it's fair to say, I think, have been completely blindsided by inflation. A few months ago, March, April this year, the Federal Reserve itself was worrying about deflation. So this overshoot of inflation above targets over months has been a significant surprise to central banks and economic institutions in general. So with inflation beginning to dominate headlines, communications, eroding real wages, etc., in our view, the currency markets of the next few months are all going to be about inflation data and the major central banks' responses to it in terms of how they withdraw. So that is the context. Now I'll pass on the baton to Matthew, and we will focus in more detail about what's going on in the world markets and what impact we can expect the Federal Reserve meeting and the German elections to have.
Yes, thank you, Enrique, and thank you everyone for joining today. As Enrique mentioned, I'm going to kick off by giving a brief sort of introduction and overview as to the main sort of themes we're seeing in the market at the moment, what do you think are the main drivers in the currency markets, and what are we going to look most closely at, whether that's central banks or economic indicator data over the next sort of 6 months or so. We'll then pass back to Enrique, who's going to give more detail about tomorrow's Federal Reserve meeting. And Roman's going to wrap things up by talking about the German elections and in particular what kind of impact we think the elections may have on the euro. We'll then finish with a Q&A session at the end. There is a Q&A section in the Zoom app, which you may see on your screens at the moment. As we go through the presentation, please feel free to type in any questions that you may have, and then we'll get round to answering those at the end. So as I said, I'm going to start by giving a sort of brief overview as to what the main themes we're seeing in the markets at the moment. Focus in financial markets and in FX market is shifted in the last sort of 2 or 3 months or so. Attention in the first half of 2021 among currency traders was very much firmly fixed on the COVID-19 pandemic, namely the ability of authorities around the world to rein in rates of virus infection, and also, of course, the speed at which countries around the world were able to vaccinate their populations. Those currencies or those countries that tended to roll out their vaccines the quickest generally saw their currencies outperform. If we look at the G10 Performance Tracker on the right-hand side, so the G10 Performance Tracker versus the US dollar year to date, we can see that the 3 best performing currencies so far in 2021 have been US dollar, pound sterling, and the Canadian dollar. These are three of the currencies that have outperformed, in part due to the impressive rollout of vaccines in the US, in the UK and Canada at the early stages of the vaccination programs earlier in the year. This has obviously allowed for a relatively quick unwinding of lockdown measures in those countries, particularly in the likes of the US. The US was one of the first major nations to materially unwind lockdown measures earlier this year, in large part due to the vaccination program. Also, US authorities more relaxed approach to enforcing measures compared to many other countries in Europe, for instance, that have taken a much more stricter approach. Now that the majority of these major countries have rolled out vaccines to most of their populations, focus has shifted away from vaccinations, and indeed, for the most part, shifted away from the COVID-19 pandemic. I say for the most part, we have seen bouts of risk aversion in the last few weeks and couple of months or so, particularly as a result of the spread of the Delta variant, which is now the most dominant strain of the virus worldwide and has led to the reimposition of lockdown measures in many regions, particularly the likes of Asia, for instance, which has suffered quite aggressive increases in infection rates in recent weeks. Aside from that, the general sort of theme has been one of optimism in the markets, and investors have very much turned their attention to the more conventional drivers of currency markets that we saw prior to the pandemic. We think of macroeconomic data, for instance, central bank monetary policy, politics, have very much come back to the forefront. And we're going to talk about all three of those today, particularly the performance of the US economy leading into tomorrow's Federal Reserve meeting. And as I said, Roman's going to finish off by talking about the German elections on Sunday. But generally, the main focus has been shifted back to these central banks. Primarily, the real question is, when will these central banks begin normalizing monetary policy? Most, if not all of them, cut interest rates to record low levels at the start of the crisis. Now the lockdowns have been unwound, economies are recovering, inflation has risen aggressively. The real question is that when will these central banks begin unwinding their QE programs and hiking interest rates? So that's going to be the main focus, we think, in the markets in the next few months or so. Probably the main rationale as to why these central banks have taken on a slightly more hawkish approach in the last couple of months or so has been this sharp increase witnessed in global inflation. Inflation has risen relatively aggressively in most major nations, with a few exceptions, in the last 3 or 4 months or so. And there are a number of reasons as to why this is the case. Probably first and foremost would be the unleashing of demand. Now that lockdown measures have been unwound in most major nations, all this pent-up demand that has accumulated during the crisis period has been unleashed. At the same time, supply has struggled to keep up with this sharp increase in demand. We've had acute supply shortages in many industries, particularly in durable goods, for instance. Supply, of course, contracted significantly at the beginning of the pandemic, and it's a gradual process for that supply to keep up with the demand, particularly in durable goods. We look at the car industry, for instance. It is not something that overnight supply can increase. So it's going to take a little while before that imbalance goes away, hence why we're seeing prices continue to remain at such elevated levels. Commodity prices have also risen as well. We've seen oil jump by over 50% or around 50% since the beginning of the year. And we've seen broad increases in other prices in industrial and agricultural commodities, for instance. All that's led to this sharp increase in prices. We look at the G10 Inflation Surprise Index from Citibank. You can see the chart on the right-hand side. Any number above 0 suggests that the data is surprising to the upside. Number below 0 suggests that the data is on the whole missing expectations. Well, this actually rose to a fresh all-time high in in August, suggesting that the data, inflation data, is coming in much higher than economists' expectations, and also expectations of central bankers. So this has very much brought forward the market's timing for when central banks will start normalizing policy. Some have already indicated that higher rates are on the way in the next few months. Others suggested, or at least hinted, that policy normalization could be on the cards perhaps sometime next year. But we very much think that these the latest inflation developments will be key to when these central banks start both unwinding their QE programs and hiking rates. So the market will be very much fixated on upcoming inflation prints, particularly out of the major developed areas, certainly in the next 2, 3, or 4 months or so. So what can we expect from the major G10 central banks? Well, as I said, some have already indicated that higher rates are on the way. We have two that are very much on course to hike rates before the end of this year. Norges Bank in Norway is expected to hike rates later this month. Reserve Bank of New Zealand in October. So these two are expected to be the first to hike. In contrast, we have the likes of the European Central Bank, Bank of Japan, that are very much lagging behind their peers. Actually, we think that those the currencies of those central banks on the left-hand side of this chart, i.e. the ones that are either already indicated that hikes are on the way or may well raise rates next year, likely to see their currencies outperform, in our view. Look at the likes of the New Zealand dollar, for instance, Norwegian krona, the pound, Canadian dollar, for instance. Those on the right-hand side that are a long way away from hiking rates, Japanese yen, the euro, for instance, we think that those currencies could potentially underperform as a result over our forecast horizon. As far as the Federal Reserve is concerned, Enrique will talk about this more in detail in a little bit, but the market's currently pricing in the first interest rate hike from the Fed the end of next year, but tomorrow's meeting will be key to markets' expectations for that first hike. Lastly from me, before I hand over to Enrique, as we're of course talking about tomorrow's Federal Reserve meeting, it would be remiss of us to not talk about the US dollar and how the dollar has performed so far this year. The dollar has actually been the best performing currency in the G10 year to date as of today. We've seen a little bit of a rally in the past couple of sessions in the US dollar. There's been a number of reasons for that. We've seen that the move earlier in the year, certainly in the first quarter of 2021, was very much driven by, first of all, the very rapid rollout or early rollout of vaccines in the US, which led to this very swift removal of shutdown measures in the US earlier in this year. Joe Biden's very generous stimulus package was also launched, which again was perceived as a US dollar positive. So we saw the dollar rise to its highest level, and I think it was around 5 or 6 months at the end of March. Since June, we've seen another rally in the US dollar. I think this move has been less so driven by the outperformance in the US economy, but more so by this sharp increase that we've seen in US inflation. And that has brought forward expectations for when the Federal Reserve will begin both tapering its QE program and hiking interest rates. So the dollar is now round about just shy of its highest level since November 2020. It's also benefited in the last few weeks from a few safe haven flows as well. Concerns surrounding the spread of the Delta variant globally has been a net positive for the US dollar, which tends to benefit during periods of uncertainty due to its safe haven status. But the big question now is, how will the US dollar react to tomorrow's Federal Reserve meeting? And to answer that, I'm going to pass over now back to Enrique.
Thank you, Matthew. That's on to the event that called for this webinar in the first place. What's going to happen tomorrow on the all-important September Federal Reserve meeting? The biggest, the uncertainty as to the headline results of the meeting is, will they announce a tapering, meaning a gradual cut in the number of treasury bonds that they purchase every month tomorrow, or will they wait till November? I think that it's going to be a close call, but I think that the market consensus that they will wait till November, that the faction of those led by Powell will gain the upper hand is correct, and tomorrow we'll just see it. However, it will be a very difficult balancing act. On the one hand, U.S. inflation is running way above targets. So we had headline around 5%, core around 4%. This compares to a target of 2%. And again, I have to emphasize that nowhere in the Fed forecast of just a few months ago could you see a prediction of such an inflationary outcome. It is true that the Delta variant the states presents a risk to the near-term outlook. Perhaps partly as a result, the non-farm payroll, the number of jobs created in August came in under expectations. But I have to say that the latest numbers indicate that the Delta variant impact on hospitalization and deaths seem to have peaked, and that I am skeptical that many business people or workers in the US are letting their employment and hiring decisions be guided by or influenced by the Delta variant. However, there's enough uncertainty out there with the Delta variant and the weak August report to assume that Chairman Powell will carry the meeting and will be able to delay the start of the taper until November, in keeping with what we think is a significant political shift in the US, in that policymakers are now erring always on the side of more stimulus and rather than preempting inflation. You go to the next slide. So the US economy has rebounded strongly. It has led most of the rest of the developed world, in particular the Eurozone, partly because the initial vaccination effort gained traction faster in the US than in the rest of the world, although now it's faltering. And as a result of an early success, lockdown measures were removed sooner than definitely than the Eurozone. We had growth of 6.6% annualized in Q2 after 6.3% in the first quarter. We're looking at slight weakening of growth, but to a still healthy 4 to 5% level. And Moody's back to normal index suggests the economy is roughly at slightly below 90% of pre-COVID capacity. But as we saw earlier, the US dollar has already outperformed this year, and we think that that outperformance already prices in the earlier than expected, the earlier rebound in the US economy compared to other economies, in particular to the Eurozone. So we think that the news may now shift to other areas that lack the United States in removing lockdowns, and where growth is supposed to be stronger in Q3 than in the US as a result. So next slide. Business activity is very high. It is true that recent indicators of economic activity are peaking, but let's keep in mind that they're peaking at very high levels. The PMI indices of business activity, which are probably the quickest, most timely gauge of economic activity, in which business manager have asked very simple questions about whether they're seeing their business grow or not in the last month, are rolling over, but at very high levels. Basically, anything above 58 or 59, which is where all the indices are, indicates that that the large majority of businesses are seeing expansion. Consumer spending activity has kept up with business activity. Recovery has been uneven, but nevertheless, demand has been well supported by the variety of direct cash transfers and expanded unemployment benefits programs that the US government passed to deal with the pandemic. The spread of the Delta variant is not clear what impact it will have, but we're confident that the impact of the Delta variant, the latest wave, will be much more muted than any of the previous waves. So We think that the concerns about the Delta variant impact on the US economy and US economic recovery has been, for the most part, overstated. And I will say that in my view, the main limits to US economic expansion now are capacity issues, supply chain issues, shortages, inability to match workers with job openings. And we'll see that in the next slide, I believe. We go to the next slide. Again, I'll go over very quickly this impact of the virus spread, because all available evidence is that the Delta variant has had a much more modest impact on the US than previous. Cases and deaths have increased sharply, though deaths have stayed lower than in the previous waves. Mostly right now, the hospitalization and deaths are an issue for the unvaccinated, people who refuse to vaccinate. We think that as more mandates are passed for vaccination, the percentage of the adult population that is vaccinated would increase towards European levels. And so we do think that this wave of deaths and hospitalizations will be the last significant one, at least for a while. However, the fact of the matter is there's been a wave of deaths and hospitalizations. And I think if the Federal Reserve is looking, the majority of the Federal Reserve members are looking for an excuse not to start the tapering process tomorrow, they have it and they will use it. So I was saying about the supply constraints in the US economy. I think this is something that we're seeing for the first time, I think, since perhaps in many decades, perhaps since the 80s, where the main constraint to US growth is not on the demand side. People have plenty of money. People are buying and spending money freely. The main constraint is the inability of businesses to service some of that demand. First, the pace of hiring slowed in August in spite of this relentless demand. You still had a creation of 235,000 jobs, which in any leading up to the crisis would have been considered an excellent number, but given the still existing gap in the number of jobs between now and where we were on the month before the pandemic, it's underwhelming, and it's definitely below the consensus. We call for more than 3 times that number. Why are we seeing these underwhelming job numbers, at least for the month of August? Well, this report called the JOLTS report, which provides some insight. The JOLTS report gives you a sense of the number of unfilled job openings in the US. How many jobs are being advertised or publicized and have not yet been filled. And as we can see, this number has shot up to all-time highs. The disruptions of the pandemic are making it difficult and painful to match available workers to available vacant jobs. This is not a process that is going to be solved overnight. And I think that until you see a significant downturn in figure 10, in the number of unfilled job positions, I am skeptical that inflation will take a sustained turn for the better. So if you go to the next slide, I think that partly as a result of this difficulty in matching job openings with workers, and partly because of more general supply side disruptions, and partly because of specific sharp spikes in certain sectors, such as used cars, new cars, and energy commodities, we've had a 13-year high in inflation to 5.4%. There was a slight moderation in August to 5.3%, but this is still way above the Federal Reserve target of 2%. More ominously, core price growth is now at a 30-year high, above 4%. In the past, most of the spikes in the headline number of inflation could be explained by temporary increases in energy prices, sometimes food prices, but more often energy prices. And so you could be confident that once prices in this sector stabilize, inflation would come back down to where core was. In this case, we can have it, the fact that core price growth has risen almost as much as headline indicates that that the inflationary pressures are widespread and unlikely to be resolved very quickly. And now Chairman Powell has insisted, of course, that the spike in price is transitory. In the last meeting, we detected less certainty in his assessment that inflation is transitory, but we think that that people change their minds slowly. And so tomorrow, which is what the focus of this webinar, we do not expect there to be to surprise the markets with an announcement that the taper starts immediately, which would be, if it happened, would be considered quite hawkish and would send rates probably much higher. Next slide. So all in all, there's been not all, but some Federal Reserve Open Market Committee members, which are the ones who make the decisions on monetary policy. It's clear that over the last few months, a hawkish faction has been developed of a minority of members who think that inflation is much less likely to be transitory than it was thought a few months ago. I think that there's a general consensus among all members, not just the hawkish members, that the enormous monetary stimulus implicit in 0% rates and $120 billion per month purchases of government debt is not needed. But like we said, we expect the downside surprises to August inflation labor market to give just enough ammunition for the dovish majority to delay the tapering to November. However, we do expect them to give strong hints tomorrow that the taper is coming in November. This is not clear when the impact in the US dollar will be if our forecasts turn out to be correct, because that is also the market consensus. However, any surprise to the upside, either in hawkish rhetoric or definitely an announcement that the tapering starts immediately, will be a significant positive for the US dollar, but we do not expect that. Next slide. Now the dot plot. We think that a lot of the action will happen in the dot plot, and that's where there's room for surprises. The dot plot is this graph where every voting member of the Federal Open Market Committee has to give his or her view of where Federal Reserve rates will be at the end of each of the next 3 years. We think that the descent that we expect to see in the Federal Reserve meeting between a growing but still minority faction of hawks that are increasingly worried about inflation and everybody else will be seen clearly in the dots plot. We expect to see, this is the dots plot from June, the last one that was published. We're already starting to see a lot of dispersion with a large majority expecting nothing before 2020, no hikes even a year in 2023, or at most one hike, and a minority of members who are starting to see much faster normalization. We expect this plot to be to reflect this descent much more strongly. We expect to see more dots moving up in the rate curve. We expect to see a near majority of Federal Reserve members expecting a hike somewhere in 2022. And we think that it's likely that the people that are already expecting a hike in 2022 will move their expectations of hikes much higher. So we think that there's some scope for a surprise in the dots plot, mostly because it's not completely clear what the markets expect. In addition to the dots plot, GDP forecasts are likely to be revised lower, and inflation data is likely to be revised higher in what will be a warning that stagflation is starting to worry the Federal Reserve. Stagflation is the key word. Powell's comments during the press conference, I'm sure, will include the word stagflation. If it doesn't, he's be sure to be asked that question by numerous journalists. So the second source of uncertainty is how will Powell respond in the press conference to comments about the stagflation? Because it's a combination of inflation with lack of growth, and which was last seen in a significant way in the 70s and 80s. And next slide. So with that, I pass on the baton to Roman. We'll talk about the other big event of the week, which is German elections and the unusual uncertainty surrounding the outcome.
Thank you, Enrique. So Germany is set to vote to choose the new federal government and the members of the Bundestag on Sunday. And we are probably set for one of the biggest political shifts in Europe, at least in the next 2 years. Germany is particularly important as its economy consists is around 1/3 of the Eurozone's economy and more than 20% of the EU economy. It's also one of the biggest drivers, and it also has one of the biggest influence on the EU policy overall. So we are putting a particular effort to see how this election is developing. Nonetheless, the likelihood of a very significant shift in the market following the election is not our base case, but there are some scenarios that could bring some volatility, and I'll talk about it later. So we are currently seeing the end of a 16-year rule of Angela Merkel as the country's leader, country's chancellor. And from what we saw in the previous few years, and actually maybe looking even back a few decades, is that the German political landscape has become particularly fragmented. So we are seeing a rise in number of smaller parties that have started gaining more popularity recently. And the two main parties, the Christian Democrats, the Union, the CDU-CSU, and the SPD, the Social Democrats, they started losing support. And recently we saw a significant shift in support from the Christian Democrats to the SPD and smaller parties. So since the beginning of the year, where the support for the Christian Democrats stood at around 35%, even slightly more, by various polls. This one here on the right-hand side is from Forsa. It's one of the best ones as there is a large group of respondents. So since the beginning of the year, we saw a significant decrease in support for the CDU-CSU. This has been in a large part a result of a series of PR fails on the side of the party, and particularly the candidate to become a next Germany's chancellor, Armin Laschet. One of the most known PR fail has happened in July, when during the speech by the country's president, Laschet has been seen in the background laughing. Which has led to a significant decrease in popularity of his and his party. And right now it seems that it is unlikely to receive the most of the votes. It has been overtaken in the polls by the SPD, and SPD has the greatest chance to create a coalition. Right now, the support for the SPD is around a quarter of the votes, with the CDU-CSU roughly going to take approximately 20%. By recent polls. However, there is some uncertainty regarding that. Also, the differences between the parties' performance in the poll has changed a few times during the polling time. And the difference currently by various polls is between 2 to 6 percentage points. So this is a tight race, and it may well change in the next few days. As we are going to see on Sunday night how it will turn up. Can we get to the next slide? So currently we are looking at something rather unprecedented, particularly in Germany, but also worldwide and in Europe. And this is that the most likely scenario for a coalition is a coalition of three parties, because none of the two parties will likely have enough votes to create a coalition. This will mean a significant shift from what we have currently, which is a grand coalition of CDU, CSU, Christian Democrats, and Social Democrats. Currently there are 6 main parties, but the CDU, CSU, and SPD declared that they will not form a coalition with the Alternative for Deutschland, which is seen as the most radical right-wing party in Germany that is polling at around 11% right now. We are likely seeing 5 coalition scenarios, including 3 parties. The first one is Germany coalition. Then we have Kenya, Jamaica, traffic light Light, and R2G. Those names are derived from the colors of the parties. And looking at those coalitions, the ones that seem as relatively likely, most likely, are the Jamaica coalition, the only one with the CDU-CSU, and also the Traffic Light and R2G. Generally, the first two coalitions, Germany and Kenya, they seem unlikely, but they would be the closest to status quo. So we wouldn't probably see any market reaction. Where the market reaction probably would be if we were to see the R2G coalition or a coalition of the leftist parties. However, looking at the situation currently, it is very hard to predict the exact euro reaction, particularly considering that the possibilities are quite wide, and also it's quite uncertain what the market is thinking right now. But let's move to the next slide. Before the elections, we typically look at bookmakers' odds and what the prediction websites are saying. And currently, the prediction website that we prefer to use predicted that allows its users to bet on political events, indicates that there is a highest likelihood that the SPD will receive the largest share of votes and is the most likely to create the coalition, indicating that the coalition of a Traffic Light is particularly likely, with the second one being the left coalition, although it seems that a Jamaica coalition is also relatively likely. Nonetheless, we are likely to see the government led by the SPD, and this means that there is a upside potential for a few changes to the current situation, in large part that the country's economic policy is likely going to be somewhat looser, that there will be a lot more focus on the green issues, on the ecology and climate change, and there will be a focus on redistribution and closer ties with the European Union, based on the current polling at least. As I mentioned, the scenario which could prove the most market moving would be the R2G coalition, as it is the most clear among the coalitions. This is a coalition of the leftist parties. So the center left SPD, the Greens, and the left, which is sometimes viewed as a radical left, at least the most radical in Germany. And as it would mean that all of those parties would likely vote for redistribution and for a focus on climate change and stronger integration with the EU, and also maybe less reliance on the fiscal rule and less reliance on pressuring other countries to follow them. If we move on the next slide, we'll talk about the market reaction so far. So far, we haven't seen that much of a reaction in the markets. In fact, in the past few days, the market has been focused more on what's going on with China than what's going on in Germany. However, we might see some volatility if we are going to get closer to the election day in Germany. So far, we saw that the spread between the German and France bonds has increased. It is at around the highest level it has been over the past 5 months, although it is has changed only to a limited extent, but it could be related to the elections. Looking at the equity market, we're seeing that it follows mostly global trends, and the euro hasn't really reacted either at all or very much to the election prospects. Could we move on to the next slide? So looking at the scenarios that could provide some volatility, as I mentioned, the R2G is the one that would be the most likely to induce some reaction in the euro. This would probably not be extreme, although we might see something of around 0.5 to 1% percentage move in the euro dollar. This move, in our view, would likely be up, although this is not certain. We think that it will likely be positive, as the R2G coalition scenario is the most clear on the loosening of fiscal policy, and could provide for a stronger growth in Germany and in Europe, which should be positive for the euro. Generally, another coalition which would be clear is the leftist coalition of SPD and Greens. However, the likelihood of it happening is relatively low, considering that by current polling, those two parties have around 40% support right now. Nonetheless, we think that it could bring volatility, and this would mean a stronger euro by roughly 0.5 percentage points. All of the other scenarios that are likely, so Germany, Kenya, Jamaica, and traffic light and grant coalition, the current status quo, we don't think that they would affect the euro to a significant extent, as they would either be a status quo or that they would very closely resemble the status quo. So we wouldn't really count on a particular reaction to that. Maybe we think that the reaction would be capped to no more than 0.3%. That being said, after the election, we might not know the exact results. So what coalition is the most likely and what coalition we are going to end up with. So we might be set for some period of uncertainty in regards to that. And even if we have talks regarding coalition, we need to remember that there are probably three parties that would need to agree on a set of measures. And this is not an easy task. And the previous election has proved that, as initially there were prospects for Jamaica coalition, which then turned out to not be a possibility. As some parties walk away, and we have a creation of a grand coalition 6 months after the election took place. So we might see something similar, depending on how the votes will be, what will be the support for the exact parties. The initial results should be known before midnight on Sunday, although we might not know what this means even in the next days and weeks. We would have to wait for the news from Germany. Another risky scenario that we think could happen, or at least maybe isn't very likely, but would likely mean a higher volatility in the euro, is if the AfD party, the one that is deemed the most radical right-wing party, would perform particularly well, as it could induce fears of a populism being on the rise in Europe. And particularly considering that we are set for another election in 2022 in France, where Marine Le Pen would challenge Emmanuel Macron to become the next president, this could potentially induce some volatility on the euro and negatively affect the currency. But as I mentioned, this is not really expected. This is only a, let's say, a tail risk here. So yes, I think this will be all on my side. If you have any questions, please feel free to ask.
Yes, thank you, Roman. As I mentioned, there is a Q&A function in the Zoom app. So if you do have any questions at all, please feel free to type them into that Q&A section and we'll get around to answering them.
I think we have one about the election, so probably it's best if Roman takes this one.
Yes, so the question is regarding to, I can read it out. With all the changes in the polls, do you think there is a risk in Germany to have a scenario like the Netherlands with a long period of negotiation?
Yes.
Do you want to answer that one, Roman, first?
I think it's very likely that this is going to happen. Recently, we saw that some of the most recent polls have indicated that the gap between the parties have tightened to approximately 3 to 4 percentage points. So this means that, yes, the election result is quite uncertain. And considering the past, where the negotiations took a long time and then the negotiations did not result in the creation of government, we might be bound for a similar situation. So yes, I think that this might be very unclear even weeks or months after the election.
Yeah, I think it's actually one of the sort of big risks going into the election. Markets generally tend to dislike uncertainty. So as long as that period drags on and the continued negotiations after the election, the longer that period is, the greater chance we start seeing a bit more of a reaction and a negative reaction in the euro. investors tend to like these political events to be done and dusted pretty quick, so they can get an idea as to how it's going to affect policy. But if it does drag on for a prolonged period of time, I think that's when we might start seeing more of a downside in the euro.
Yeah, and I also mentioned that it is actually hard to predict the actual reaction in the currency to the leftist coalition, as on one side, we would likely see more fiscal spending, which would be positive for growth. On the other side, some of the propositions of particular parties could be seen by the market as quite radical. So it is hard, particularly the wealth tax. So it's hard to exactly see how it would react. Also, in the past, we have sometimes saw a change in the reaction of the market, even during the election night. So this was the case in the US in 2016, where initially Trump was viewed as a risky candidate, and the market sold off when it became known that he has the highest likelihood of winning the presidency. Only then for the dollar to appreciate when the market started focusing on the prospects of fiscal loosening. Here, it would not be as obvious, particularly as the more spending and more focus on redistribution to the low and medium income families would be balanced potentially by higher taxes, particularly if we were talking about the coalition including the Linke. However, yeah, this is quite a hard hard thought experiment to conduct, to have expectations regarding the euro-dollar reaction in that context.
Yeah, I think that's a very good point. It's very good to sort of differentiate the immediate reaction and the sort of more medium-term reaction in currencies and financial markets in general following these political events, because often they can be slightly different. Another question, again, Roman, perhaps maybe you can take this one as being our sort of resident expert on the German elections. This question is, why is no one predicting a landslide victory for the CDU?
Well, currently, even when they were polling at similar levels to the previous election, it was unlikely that they're going to take a lead. Their chancellor candidate is extremely unpopular right now, and the polling regarding his chances of becoming a chancellor are at around 10%, maybe 20% at best. So I think that it is extremely unlikely that the party will perform well and that we are going to have a landslide victory. Right now, there seems to be a little bit of a shift in that they are gaining a few percentage points in the polls, but this is not likely going to translate into a significant shift in the votes. So yeah, I think it's extremely unlikely, and in large part due to the candidate for the chancellor.
We have another question as well. So in our perspective, what would be the top of euro dollar if those negotiations in the German election take too long to be solved?
Okay, I think I'd like to answer this. I think that the euro would be quite resilient to the sort of instability that would be caused by prolonged negotiations and a caretaker government, mostly because there's no immediate critical decision that needs to be made by the German government. I wouldn't go as far as say that policies on autopilot there, but I think that we could tolerate a fairly prolonged period of discussions and negotiations without much damage to the euro. Regarding the Evergrande situation, the risk for Europe, I mean, the key thing is to evaluate the risks for China. Now, Evergrande by itself, it's a large company. It has 300 billion of liabilities, meaning that there's 300 billion worth of exposure out there. But there's a lot of mitigants to that exposure. First of all, it is not new. The bonds have been trading way below 50 cents on the dollar, 40 cents on the dollar, 30 cents on the dollar for some time. So a lot of those losses have already been absorbed by the people holding those liabilities. It's no surprise, and in fact, the bonds are not much lower now than they were a week ago. And second, there is some assets in Evergrande that are worth something, perhaps not what they're carrying the books at, but something. So when you put in perspective a reasonable worst case scenario of losses from Evergrande relative to the size of the Chinese economy, Chinese foreign currency reserves, the Chinese ability to intervene and distribute losses, as long as the problem remains contained to Evergrande and perhaps a couple of other of the more leveraged realtors out there, I think we think the problem is manageable. And that's why, I mean, we saw a 2% sell-off in markets yesterday. Markets already rebounded, and frankly, the yuan has barely even moved and still near all-time highs. So at this point, we are within that what happened yesterday in the markets was an overreaction to the Evergrande situation.
Yes, although at the same time, I think, if I may add, that the quite a realistic risk that we are seeing, and that I think that has been brought to markets' attention by the Evergrande situation, is the deceleration of growth in China. And this is something that has been confirmed by the recent economic data, by the PMI numbers, both the official PMIs and market PMIs that have been released, particularly for the month of August. We recently also received some hard data on China that has shown the weakness in the retail spending, which extrapolates to consumer spending. So this Evergrande situation could potentially flag a downside risk to China's growth. And I would believe that a risk to the global situation would have more to do with a deceleration of growth in China. That is further emphasized by this Evergrande situation than a potential spillover of China's problems elsewhere. And we might see some further weakness in investments and possibly also in consumer spending, depending on how the Evergrande situation will resolve itself.
Great. We have another question on inflation in Europe. And perhaps that inflation in Europe may soon be much higher than expected by ECB President Christine Lagarde. So what was our view on how this might affect euro dollar? Well, it's a very good question. We've actually seen this the latest month of data of Eurozone inflation that came in much significantly higher than what we've seen in the last few months. I think probably the key, though, here is to look at the core measure of inflation in the Eurozone, which is the main rate of inflation that the ECB looks at when deciding on its monetary policy. We've seen a sharp jump in the headline rate. The core measure, though, however, despite increasing in the last month, in August, still remains well short of that 2% target. As long as that remains the case, I think there'll be very limited pressure on the ECB to rush into normalizing policy. We don't think that a tapering in the QE program is too far away, but certainly rate hikes in the Eurozone appear a long way off. And we've also had the ECB change to this symmetric inflation target, whereby it will look through periods of above target inflation or below target inflation, and instead target at some more average inflation around 2% over time. So I think that gives the ECB a little bit of a leeway. It alleviates pressure on them to hike interest rates should we continue to see this jump in inflation. So I think we're pretty comfortable with our euro dollar forecast at the moment. And until we see this as a more sustained upward trend in core inflation over a prolonged period of time, I think there's very little pressure on the ECB to act. What do you guys think?
I mean, clearly the idea that the inflationary pressures were restricted to the US has been put to rest by the recent data, both in the UK and the Eurozone. That inflation is a global phenomenon. Europe probably has its additional issue with gas prices and electricity prices that will make the inflation of the next few months perhaps even more severe in the US. And in the meantime, we have markets pricing no hikes from the European Central Bank until 2025, which I frankly think is a bit deranged. I think that those expectations of hikes, of not just reduction of the pace of monetary stimulus, the taper was already announced last month from the Eurozone, but actual hikes need to be brought forward massively. And so I think that because of the Eurozone starting from this position where markets expect policy to remain looser for much longer, there's much more scope for those expectations to be reset, and that can only be positive for the euro dollar. So to me, the fact that the expectations from future tightening monetary policy in the Eurozone are so out of touch with the inflationary realities on the ground, that actually tells me that that there's potential upside in the euro as those expectations get repriced. That's my view.
Yeah, I would generally add that the ECB and central banks, they cannot really do anything about shifting freight rates right now, about higher energy prices and about things like that. So it's possibly better for them not to overreact than to react to something that they shouldn't react to. And also additional argument is that the inflation next year should be influenced by the base effect in a different way than the inflation this year. So because of the increase in oil prices, particularly, we are likely going to see a lower inflation in 2022 because the base would just be so much higher than it was in 2020, to which we compare the current price levels. So this should be leading to a lower inflation. And upside risk, in my view, would be the higher energy prices. Right now, we are seeing a perfect storm in Europe, particularly in the UK, but also in the continental Europe, that could lead to a higher energy prices, particularly for companies, but also for consumers. But again, the central bank cannot really do much about those prices, if anything.
We have another question on the Swiss franc. So how do we see the US dollar Swiss franc cross in the coming weeks? It's a very difficult one to sort of answer in the sort of shorter term. I think longer term, I think we're sort of the view, Ebury sort of opinion house view is that the Swiss franc will be one of the underperformers in the G10 as we sort of emerge out of this the pandemic period. I think as vaccinations continue to progress, particularly among developing nations, we'll start seeing removal of lockdown measures in more of these emerging market countries. It should be good news for global growth. We've got a pretty optimistic view on growth. And that, we think, it should be good news for risk assets, such as emerging market currencies, and particular negative for the safe havens, the Swiss franc and Japanese yen in particular. So I think we generally, over a more longer time period, have a generally negative view on the Swiss franc as we sort of emerge from the pandemic before it sort of finds its level against the euro in the more longer term.
Yeah, generally, when it comes to the franc, I think that there are two things that you should focus on right now. One is the behavior of the US yields. If they are increasing, we are seeing that it has a strong negative effect on the franc, and everything suggests that we are going to see an increase in the US yields in the next few years. On the other hand, the risk sentiment is also important, and as we expect the risk sentiment to be positive in the next few quarters and further down the road, we also expect the safe havens to underperform. So based on that, I think that the expectations towards a weaker franc are well based. Additionally, I think that the market sentiment seems to be turning bearish towards the franc, looking at the speculators' positioning. Recent data from the CFTC shown that net longs have turned into net shorts for the franc. However, how it will perform against another safe haven, the US dollar, I think is much more of an open question.
We have another question. How do you see the end of the COVID-19 moratoria? How do you think it'll affect banks and currencies? you want to answer that one, Enrique?
Yeah, I think that we went over that in the presentation. We think that in general, it means that a boon for inflationary pressures. We have this pent-up demand being released on a supply side that is still suffering from dislocations from the pandemic and is trying to rebuild as quickly as possible. States throughout the world have done a very good job of maintaining demand and maintaining incomes. Another question is what happens as those incomes attempt to get spent providing goods and services with the supply, which the economy has difficulty providing. So I think that most of the impact is in the form of inflationary pressures, longer and higher and for longer than the markets expect. And the key question is, how will the different central banks respond to those inflationary pressures, and how quickly fiscal and monetary stimulus is reduced. From the bank's perspective, well, this means inevitably in the medium and long term higher rates. Low rates close to zero have been one of the headwinds for the banks that make banks' business more difficult. So at the margin, we think that this potential for higher rates is good for banks and banks' businesses in general, and financial companies in general.
Okay, excellent. I think we're pretty much done for time there, just on the hour. And there's no more questions. So I think we'll end it there, shall we? So thank you all very much for joining, and we'll hope to do another one of these at some point in the not too distant future.
Thank you.
Thank you, everyone.